Today, I have the pleasure to have Christian Pomerleau. Christian is from PMML. Uh, Tell us, because I was watching before the recording, so I think you wear many hats, so I don't want to say something wrong. So I know you're a mortgage broker, but I think you do other things at PMML. Tell us exactly what you do.
Absolutely. Well, thank you for having me on your podcast. Actually, I am a mortgage broker, so I do have that license. And also, up to last year, for the last 11 years, I was actively mortgage broker with my own firm inside of PMML and teammates. But I've been driving the people a lot here and helping in the hiring and in the training. And last year, uh, the uh, the uh, the owners of PMML, Patrice Ménard and Sana Benzacourt, have decided to appoint some managing partners to take care of the real estate part and also to take care of the mortgage division. And so I became managing partner, taking care of the whole team of PMML across Quebec and also within our expansion that we're doing towards the west with Ontario and Toronto and all this, and toward the east also the Atlantic regions. So I'm taking care of the whole team. I do a lot of financing through the team as of now also, and I continue the training and the expansion of PMML.
Okay. All right, so we're gonna jump in right into the topic. So we're gonna be talking about the profitability of a multifamily unit. So I want to go into like kind of a education course, like a 101 on looking at if someone is buying a property, let's say a 20 unit, what are some things that they have to pay attention to see if the property is actually profitable?
Yeah, there are definitely many things. Do you want to limit our conversation to multi-res, or do you also want to look into the pure commercial properties, for example, like office, retail, industrial? Is that something interesting for your people, or really more
Multi-residential, multifamily, multi-logement.
multi-logement? Yes. Okay, good. So definitely, when people look at their property that they would like to buy, the first thing is to know a lot about themselves. So what I think is important in this market is to really be prepared. So it's fun to go out there and start looking at either Centris or even our listings. We have so many listings under pmml.ca and other brokerage firms. And then we look at that and we get interested, but still we have to look at what we have to offer to a certain extent. So I'm talking there also some experience, but the most important is how much could we put down, because it's not, you cannot, a lot of schools and training facilities out there say that you could buy with no money, which is partially true. Like maybe you won't put any money, but in your property, someone's going to put money. So it could be either a private lender or it could be another partner. So they show you all these techniques and these tricks so that you could start buying without having any money. So that is true. But when you start looking at the deal itself, definitely someone's going to have to bring some cash down. You cannot buy with zero. Like cash is king right now, and banks see this and they want you to have some leverage in your building and not just the bank covers everything. Because it's too easy, you start buying, you put no money, and if everything turns sour, doesn't go well, then you bring back the keys. And that's it. You just drop them there, and who has a problem? The bank now, because you put nothing in the property. So now properties, banks, they want you to have skin in the game. So that's important to know from the start. Like, what do you have to bring on the table? Whether it's your own money or someone else's money, but at least you have an idea what you're starting with, and then you could start looking into sectors that would fit what you want. For example, someone that has $200,000 or $300,000 available is going to be difficult for them to enter the Montreal market, for example, because everything is based on, I'll get to that a little later, but everything is based on economical value. And and what that means is that what you think could be a good down payment because you make a calculation, you say, oh, I've heard that CMHC, you could only put 5% down. So people do a reverse calculation and they say, oh, my $300,000 could then buy me something of like 1.5 million. And however, it doesn't work like that because we're going to do this calculation based on the economic value of the building, and then you're caught and actually you need six, seven, $800,000 down payment for that property. So this is why there's some basic knowledge you have to know, and when you're on the lookout, you have to know what you're looking for. Know your area. So someone that really wants to get into real estate should really study their area and look at what's being sold out there, what are the types of prices that they're being sold for, and they get used to the pricing. For example, a sixplex in Montreal in this sector, or someone that is more in the sector, for example, of Laval, on the peripheries of Laval, or in Mirabel. Well, once you start looking at a lot of listings, it could take a couple of days. You get used to some types of pricing. And if the listings are complete and they also show the cap rate or the gross income multiplier, the GIM, and then when you see these, you get used to them. So the next one you see, the next building, next property you see that comes up on Centris or in a file, you can look at it and rapidly say, "Hey, I think that's a good deal. I think this makes sense." And then you have to look at the age of the building, whatever has to be put in the building on the long term. So talking with the people that sell or looking at the listings, you could discover these things, and you understand that, oh, I have a lot of capex or capital expenditure to put on this building in the future. So I have to factor this into my price that I'm gonna allow to put on the purchase offer.
So all that so it has been more sophisticated now than before. Like maybe someone was purchasing a building in the 80s or maybe in the 70s. Now is different doing the calculation. It's not like just going and looking at the income minus the expense and then everything and that's it, then we're done. We're just buying the building. It has become more sophisticated over the years, right?
Yeah, absolutely. And what happens, Richard, you talked about like 20 or 30 years ago, but we could just go back 1 year ago, and the market also changed enormously. Right during the pandemia, people were some bold, people. They decided to buy land, and they knew nothing about construction. They just went into construction, got someone there, and just did it as they thought it would be done, and the market would pardon them. The market would forgive them because of the low rates, because of the way that the CMHC and the bankers would calculate and let you take everything out. So the market was forgiving. So people made mistakes and they still got their money back. When the construction was finished, were able to refinance, get back some money, even get some profit out of that. But then as the years passed, like in 24, for example, 2024, then the bank said, whoa, 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 we're not going to allow this much money to go out of. We want you to keep money in the building. And then we also had changes in the market. For example, the people that work, la main d'œuvre. So that went up a lot, and the cost of the products, the cost of construction went up a lot. So then that forgiveness that we had before because of the rates was not there anymore. So you really had to have people a little more sophisticated in construction, and also the investors had to think and prepare even more. because the rates change. It's not all about the rates, but the rates change, and then CMHC is going to tighten the way they're gonna look at a file, become a little more like it's an insurance company, so they're going to be a little more tight as an insurer, and the easy conditions become a little more difficult, then a little more difficult. And in 2026, I would say that there has been a pretty big change in the last 6 months, even with that, with the new normalization of expenses. We could talk about that, but all this is intertwined together, and it makes for people to be a little more conservative, a little more prudent when they do their investments. But there's still deals out there. There has always been deals, and there's always deals that are going to come upon. And I know because I see them come on our desks. I see them. So once you see, you say, "Wow, what a deal! What that was great. This is like fun to finance." And there's going to be other more complex situations, and we take care of everything. And again, I come back to the fact that what's very important is to be prepared, because when the opportunity comes, if you're prepared, well, that's going to be a perfect match. And then people are going to say, "Oh, gee, you're lucky to have this." No, no, I'm not lucky. I was prepared. I look at the market. I know how it works, and I recognize the opportunity rapidly before others did. And this is my luck. So it's a lot of preparation.
So we're gonna go into the normalized expense in a few
Yeah,
seconds. I just want to go like going back to like before when people were just looking at the cash flow. One thing is, correct me if I'm wrong, if you look at the cash flow when interest rates go down, you might have bought the building when interest rates was low. That was okay, but when interest rate goes up, it affects your cash flow, right?
absolutely. Yeah, absolutely. So and also when you refinance, sometimes you take a little more out, so that also is going to affect your cash flow. It's also all about opportunity, because sometimes you don't mind that your cash flow goes down because you're going to refinance like maximum possible to get some equity out, because that equity could help you buy something which is very strong. Maybe that you're making a profit while you buy. So it's always the cost of opportunity that you have to measure, and then it becomes important. But right now, positive cash flow buildings are very, very rare. Very often, it's you finance, you get a little bit of cash flow in the building, but everything is controlled with the DSR. So
The
the debt
debt
service
ratio.
ratio.
Yeah.
Yeah, exactly. So if you want to make a little story out of that, I don't know if you had another question, but I could go down a little bit how we get to the economic value and get to all these ratings.
Yeah, you could do it.
Yeah. Okay.
Yeah.
Good. So really, in multi-res, that's what we're talking about. There's two ways to finance. You could have the conventional way, which has always been there, and it has been used less lately versus the CMHC, really because of the rates. The rates, when the rates went up, it was difficult to finance in a conventional way. And conventional, you have no insurer, and you have the bank that takes all of the risk. And normally, they're going to limit themselves to a lending ratio of about 75%, and amortization, which is going to be about 25 years. Now, CMHC brings a gift out of there, because what they do is they say, no, we could finance 25, 30, 35, 40 years, and even with the new, well, it's not new anymore, but the added MLI Select program, you could do 45 and 50-year amortization. So think about it. If you amortize on such a long period, then for sure your payment is going to be lower, which is going to allow for a bigger loan. So this is what happens with CMHC, and normally CMHC are going to have a better rate than the rate of conventional, because there's less risk. The bank sees less risk because the insurer is there to take up most of the risk. So the bank says, okay, I'll give a better rate to the client. So you have a better amortization, you have a better rate, and then in certain circumstances, you're going to have even a better debt service ratio. So it's always what you've talked about a little earlier, Richard. To know the value of a building, you have to know how much it's going to give out in terms of revenue. So we always look at the revenue, of which we take away, the vacancy and the bad debt. So that's we take this out, and then we look at the fixed expenses. For example, the tax, municipal and school. We look at the insurance. How much does that cost annually? And then we look at the energy costs. So those are the four main fixed costs. Then you can have, sometimes they offer Wi-Fi, so you're going to have another fixed cost there. So you take all of these bills annually and you take it out from the revenues. And then you have to take out normalization. So for our people out there, normalization is that instead of trying to calculate how much salaries you paid or and how much expense for maintenance and administration, what the CMHC and the banks do is they compare to the whole market. So they take out from the market some normalization numbers, which we have to apply in our pro formas. So it helps because it's much easier. We take an amount. For example, right now, it has changed last week, actually. They raised them up. But for maintenance, it's $700 per unit. So you have to factor this in. So if you have a 10 unit, well, 10 times 700 is 7,000. So you have to put this as an expense in your pro forma, and that one is normalized. Same thing for salaries, which is $400 per unit, and same thing for, it depends on the size of your building, but just to give a brief idea. And also for administration, it's 4.5 or 5%, depending on the size of the building. Those are normalized numbers, which we have to put in the expenses, and then we get revenues less all this, we get the net operating income, the NOI. And the NOI, if the people here understand one thing, is it's the most important number that you have to know for your property. Because the NOI is from there that we're going to extract the market value. So a specialized accredited evaluator will do different types of evaluating techniques to get the market value. So it's going to compare to what's out there in the market, same size buildings in the same environment, which have been sold very recently. And if you have 6, 7, or 8 of those, you could rely on their numbers, for example, to get the cap rate or to get the gross income multiplier. And once you get that from the market, you apply it to your NOI, and that gives you the market value. And they also have a mathematical way of getting it, and they apply that cap rate again and multiply it with the NOI, and they get a mathematical value. So based on these values, this gives us an idea like how much financing we could get. And a little earlier, I talked about the economic value. And just for people to know, in financing, we're always going to finance on the lowest of either the price that you have paid, the evaluation report that you got, and the economic value. So I'm giving an example. You may have a building that is offered at 2 million, and you look at it and you say, okay, 2 million, it seems to be the market value, but let's check with an evaluator. And the evaluator comes in and he says, yeah, it's good, but I would think it's around 2,100,000. So now you have evaluator at 2,100,000. You have the price that you could pay, which is at 2 million, and we're going to calculate the mathematical number now, which is the financial economic value. And how we do that is we take our NOI and we're going to apply the cap rate, but the cap rate that is limited by the debt service ratio. So this is the maximum that the bank is going to allow you. So the bank says, well, I considering the revenues and the income and my debt service ratio, I consider that this building is really worth only 1.8 million. So now in financing, we're going to just go with 1.8 million. We cannot use the other numbers. However, the client pays 2 million. So he's going to pay for example, if we finance at 85% with CMHC, we're going to finance 85% of that 1.8 million. And the difference between 1.8 and 2 million, the price that you really pay, this is going to be also some extra cash down. So this is why sometimes people, they think that, hey, I got $300,000, like I said at the beginning, and they think it could buy this and this. But once you calculate the real value that the bank gives it, which is a mathematical maximum value, the rest is cash down. So it means your cash down could be much bigger than what you initially thought. This is the concept of the economical value.
Yeah, so it's correct me if I'm wrong, it's when they do the underwriting, right?
Yeah, actually, even before the underwriting, us as specialists, in mortgage, we do the pro forma and we know exactly what the economical value is going to be.
Mm.
So, yeah, we calculate that with a lot of precision, and then it gives an idea to the client. Okay, what you thought that your $300 could buy is really going to be about 550. Do you think you could come up with that? And also, we have to think about other fees, the notary fees, transaction fees. Maybe you have to do a evaluation report. Maybe you also have to do evaluation on the land to see if it's contaminated or not. So all this could be, those are extra fees. You have to think about the 9% tax on the premium of the CMHC. This cannot be financed, so they have to bring it up. If you use specialized people like us, we also have our fees. So all these are the buying fees that you have to think about. So you have your mise de fond, your cash down, and on top of that, you have to think about all the administrative fees that you'll have to pay to acquire it. So us in our specialization, that's what we do. We take the client, and especially if they're new people and they need some training on all this, we really like kind of hold them by the hand, and then we do the whole process with them. And every time we show them like, okay, there's going to be this. Those are the fees we have to inject, because they're all responsible for that in commercial financing.
Okay. We're running out of time. I just want to try to squeeze two more questions. If you could
Yeah.
answer both of them in 1 minute each before because it's an interesting conversation. Because before when you were talking about normalized expense, what about the capex? People sometimes forget that.
Yeah, absolutely. It's a very interesting question. CapEx, normally we're gonna look at it in time, with the time. So this is why very often I teach people now to think in cycles, because today you are buying something which you're going to finance maybe on the next 5 years if you take CMHC. So if you have to put capex in the year three, and the capex is important, for example, you have to redo the brick wall. Brick wall could be like 50, 60, $70,000 if you have to do the brick wall, or if you have to do the roofing or something important. So you really have to think about it in advance. And we have a new product called Portfolio Plus, and people could put all the numbers in there and also add the capex in time. And this is going to calculate the internal return, the full return, the capital expenditure return. It's going to see how healthy your debt is. So this is something important. So yeah, it's a good question.
Last question. What would you say, what would you think is the most important metric to pay attention to? Is it interest rate, cap rate? What is it?
Uh, I believe they're all pretty much important, but let's say and I don't want to pinpoint one because you just pointed out two. For definitely, you have to know your cap rates around where you're going, where you're going to want to be investing. This is super important. In terms of interest rate, I think it's important to follow, but this is something you can't control anyways. So it's just you have to make sure that you're dealing with a good little team, making sure that they do strong pro formas, which might be recalculated in time. And I would say a third thing is go conservative right now, because if you calculate your pro formas conservative, you might not feel that you have such a super deal, but at least the deal works. And then if you did it conservative and actually the market is better than you thought and it's more positive, well, you're going to be a winner over time. But you have to look at things more conservatively. And like I said, the NOI is another one that I would always take a lot of attention to.
Okay. Where can people learn more about you and PMML?
Actually, the best thing is to really go on pmml.ca. Those that need to know a bit more on the market, and you're going to see all the things that we have on our listings. You're going to have a lot of videos to be able to get trained and get specific information on many different things. You could also go on our site and subscribe to receive the Canadian mortgage bonds, the CMBs, every day. Going to receive it at about noon on your phone or on your email, so you could watch the market as it moves in real time every day. So those are things you could do.
All right. Thank you, Christian, for your time, and thank you for accepting my invitation. I really appreciate it. On that note, everybody, thank you for taking the time to listen to the podcast, and we'll see you on the next episode. Bye.
Thank you, Richard.
You're welcome.